Hello, everyone, and welcome to today's webinar, COVID-19, Impacts on the Residential Land Market, presented by Tim Sullivan and Ali Wolf with Meyers Research. This is brought to you by the RLI 2020 Future Leaders Committee. My name is Amanda Maroney, the Education Manager for Realtors Land Institute, and will be your host for today. The Realtors Land Institute, the voice of land, continually strives to maintain its status as the acknowledged leader for all matters pertaining to the land real estate profession. RLI endeavors to remain the essential membership organization for the extraordinary real estate professionals who broker, lease, sell, develop, and manage our most precious resource, the land. We're here to provide our members the expertise, camaraderie, and resources that are the foundation for all land real estate professionals to become the best in the business. While this webinar does not count as credit towards RLI's elite accredited land consultant ALC designation, it is filled with valuable expertise. So let's get started. I'm excited to introduce our moderator for today, Matt Davis, ALC with Cushman & Wakefield out of San Diego, California, who is a member of the 2020 RLI Future Leaders Committee and will be introducing our presenters. Before I turn it over to Matt, we'd love to hear from you during today's presentation. So please feel free to submit your questions in the Q&A box throughout the presentation. We will monitor the questions and present them for you to the speakers during the Q&A portion at the end of today's webinar. So Matt, please go ahead and take the floor.
Thank you, Amanda. On behalf of the RLI Future Leaders Committee, I'd like to take a moment to thank everyone for attending, especially our presenters. We're very excited to have Senior Managing Principal Tim Sullivan and Chief Economist Ali Wolf from Meyers Research Metrostudy. Tim is a 37-year veteran of the housing industry and is an expert at analyzing and connecting economic shifts, housing market trends, and consumer preferences. His focus is to define how those factors dictate the creation of great homes, communities, and places. Tim's client base includes homebuilders, land developers, and lenders, and he has worked across the U.S. in at least 75 metro areas in the past 10 years. I've had the opportunity to hear Tim and Ali and the rest of the Meyers Research and Metrostudy team speak many times over the last few years, and I always leave with timely and useful information that I can take back and share with my clients. With everything going on in the world today, I anticipate today's discussion will be even more valuable. With that, I'd like to hand it over to Tim, who will introduce Ali and lead the discussion.
Thank you, Matt, and it is a pleasure to be here. We appreciate it, Matt, and thank you, Amanda, and welcome to all of the attendees. Allow me to give you a quick take on who our organization is. And importantly, it represents a merger of two very strong companies in the information side of market research. About a year and a half ago, Meyers Research and Zonda merged with Metrostudy. And Zonda, if you have not seen it, is a really nifty iPad-based database that tracks home sale contracts across the nation. And we're tracking 18,000 different subdivisions. On the Metrostudy side, we're tracking the same subdivisions, but we go all the way to the proposed side. So we're tracking lots through the system. And with our Metrostudy database, we're also tracking deeds and closings. Put those two things together, and we have a soup to nuts coverage on the residential side of the world. And importantly, now as much as ever, it helps to understand what's happening in real time because our Zonda database is tracking things daily. So there's not a lag time. You're able to see what's happening. Importantly to that, we have about a 500-person organization that is focused on this research. We have people that are doing the full-time research. Ali and I are on the advisory side. I oversee our national team, and Ali oversees our economics department. But we're also supported by an incredible information technology team. And speaking of information technology, we've recently brought into our company a new acquisition, which is fascinating. BirdEye is a new gig that we brought in just about a month ago. BirdEye is satellite technology to be able to track screens. Now, as you can see, at least on my screen, we have a little bit of a funky thing on the screen, but know that what it is a real-time capability of looking at lots. And we can track residential, commercial, or the other. Doesn't matter. We look at it over time. There we go. We look at it over time, and it allows incredible real-time capabilities of tracking what's happening on the ground. This is going to transform, I believe, the way that we do our research. Now, today we're going to talk about a handful of things. Allie and I are both here to kind of split the conversation where Allie will talk about the economy, I'll talk about some housing specific things. But importantly, it is always such a great pleasure and honor to introduce Allie Wolf, because Allie is our chief economist, but she's so much more than that. With a London School of Economics education, but an on-the-ground capability of grasping what's happening in housing, I've watched Allie and our organization interact with our entire national group, and she gets out in the field, at least when she could get out in the field, and is able to identify the differences and similarities betwixt and between markets. She is a constant learner, and the thing that I admire most is that she's brought our economics team into a real-time assessment of what's going on in the market. So ladies and gentlemen, you're in for a treat today as Allie dissects the good news, the bad news, and the what ifs. And most importantly, that what if is always an important element of Allie's research. She's constantly asking that of herself and then applying the so what factor. So what does it mean, and what do we do with it? Ladies and gentlemen, it is with my pleasure. Here comes Allie Wolf. Allie?
Thank you, Tim, and thank you everyone for joining us today. As Tim mentioned, we're going to go through kind of the good, the bad, the ugly, the opportunities. And unfortunately, the way we have to structure this presentation is that stage one is going to go through some of the ugly. And as we go through that, we then will talk about the policy response to be able to offset some of those challenges. And then we'll finally talk about the interconnectivity between the housing market and the wider economy. As you saw on Tim's screen from the last one, my computer has a hard time sometimes rendering photos in PowerPoint mode, so there may be a couple more that look a bit funky when we're actually in this look. Now, we do weekly presentations every Wednesday at 11 o'clock Pacific time. They're free if anyone wants to join. But one of the things that I have found that people really enjoy is when we go through what has changed in the past week. We really call these our economic quick hits to set up the stage for the rest of the presentation. And then we go into some data to back some of these topics. And so we always break them into three sections, talking about containment measures, housing, and the economy. And on the containment measure side, there goes the photo again. On the containment side, what we see is that we've seen parts of Europe start to slowly open, and we've also seen parts of the US talking about opening or already going through some phase one changes. And with this, we've seen Georgia in particular had the most comprehensive plan, where last Friday, gyms and bowling alleys, hair salons, tattoo parlors were allowed to open, assuming that the business owners wanted to go through with that. Starting yesterday, restaurants could go back to full service, and we saw that theaters were allowed to open as well. Now, what's been an interesting dynamic with this is we've said that Georgia is really that important test case to see, can they juggle human safety and human life with economic prosperity and trying to bring the economy back to a point, even somewhat remotely to where we were just, 8 weeks ago. We have a local guy in Georgia who had said he actually went to the office for the first time. He has a remote office, but he said downtown where he was in Atlanta, it was still dead. So even though they have had these early phases to reopen, there's still just this hesitant consumer and this hesitant American who's saying, I don't know if I want to go out yet for discretionary things. I think I will still just do what I need to do and continue to shelter in place, even if that's different than what the government has said. On the testing front, we have seen some really interesting insight come from both Los Angeles and New York. As we all know, there hasn't been enough testing, so we don't truly know how many people have possibly had COVID-19. In LA, the trials show up to 6% of the population already has, and in parts of New York, that can go as high as 20%. That goes to the fear of the asymptomatic people, but there's also hope that maybe, whether or not you believe the herd immunity is a real thing or not, maybe that will be good for being able to get the economy back on track. On the housing front, yesterday, new data came out that 7% of mortgages are in forbearance. So as we talk about some of the employment stats a little bit later in the presentation, that 7% are people that are saying, hey, I'm not able to make my payment, I'm going to have to delay it. And really good news yesterday as well, a lot of the stories said that the mortgage servicer said, okay, cool, you can delay your payment, but you have to give us a lump sum. So if you skip 1, 2, and 3 on month 4, you got to give us all 4 of those months. And obviously that's not going to work. And that's been the biggest concern. And actually the administration came out, the Federal Housing Finance Agency, and said, at least for government sponsored loans, that's not okay. And it has to be a free payment plan. And on the economic front, and this is where we'll transition into those econ slides, I'm sure many of you know the data has turned incredibly ugly. If you look at the manufacturing sector, that's down, and it was the biggest drop month over month since 1946. You have seen that home sales have really started to fall back. Our new home pending sales index shows transactions are off 33% month over month. The energy market is still really, really hurt. Obviously, we're not seeing the negative futures like we did a few weeks ago, but oil prices are still between $10 and $15 a barrel, which not only impacts the energy companies, but also their banks and each of the economies that are dependent on that. And so as we start from just going to the high level, what are the things you need to know over the past week? We also want to talk about the labor market. And there are so many unique things going on in the labor market right now. And the way that I need to show it to you is through two different sources. And I want to send this high level so you can understand why I'm going between these sources. And it's basically that you're going to see initial jobless claims, which are real time. This is happening right away every Thursday. So you'll see this come out in 2 days from now. It tells you what had happened the week prior. And the beauty of this is that it's real time. It is really helpful in a down market. It's really helpful in a changing market, but it only captures jobs lost. So we know that some companies, Domino's, Amazon, they're hiring, and that's not going to get picked up in initial jobless claims, which can make the market look a little bit worse than what it really is. Non-farm payrolls are incredibly lagged. The only data we have right now is through March 14th. Just think back to March 14th and how the economy was in such a different place. But it also allows you to see sectors. And so when you can look at these two together, that's when you can get a true story of what's going on with the labor market. And we know that the labor market is the most important thing to monitor in today's economy. If you look at GDP, 70% of the growth comes from consumers. That is the critical component. And right now, in just the past 5 weeks alone, 26 million Americans have filed for unemployment benefits. That is an all-time high. That is a record level of how quickly this hit. And as we look at the initial jobless claims, that report does not come with an unemployment rate. It just gives you that total number. And so what we wanted to understand is no one really understands what 26 million means. It feels out of context. We can't really understand it. So we took that number and we applied an unemployment rate to it because we all can relate to an unemployment rate. We know that going into this, it was 3.5% nationwide. And right now, if you look at that 26 million, it still actually pains me a bit to say this, the implied unemployment rate, given the people that have filed for unemployment claims, is at 20%. Now, this was expected. Our Treasury Secretary, Steven Mnuchin, came out and said, expect 20%. James Bullard is the St. Louis Federal Reserve president. He says expect 30%. But the silver lining in this data is the amount of Americans that have been furloughed, that have been put on temporary layoff, and they can still get access to unemployment claims. They can still get some of that assistance from the government, but they are likely going to have a job when we start to see these companies start to reopen. Now, given that, what we can see is the implied unemployment rate is closer to 14% if you adjust for the furloughs. For context, if you think back to the Great Recession, the unemployment rate got up to 10%. But as we see a little bit later, and as I'm sure you guys feel on the ground, there are some sectors that are going to be worse than others. There are also some markets that are worse than others. What we're showing you here is how the initial jobless claims are distributed across the country. And you can see the largest share and the smallest share. In Nevada there, you can see it's one of the darker blue, so darker means worse. What that 23% is telling you is that 230 people per 1,000 workers in Nevada have filed for unemployment claims, or 23% of the market. So it makes sense when you look at the mayor of Las Vegas saying we need to open up. They see that 20% of their population is really suffering because of this slowdown. Georgia, that's the state that we had started with. They're in the same boat. Michigan, a lot of the protests are coming from there. You see 26% of workers have filed for unemployment claims. So it's not an even distribution across the states. For the smallest share, South Dakota, West Virginia, Utah, Florida. And the reason I highlight Florida is every week this number does not jive with how we know the sectors are in Florida. We know that there are a lot of leisure and hospitality jobs. There's some tourism jobs, and we're not seeing that show up in the numbers. And we've talked to our local experts in those markets that have basically said There's a hard system where it's hard to get approved, and sometimes you have to get a paper application. And so I think the reality in Florida is a lot worse than what that number actually shows. Now, those were the weekly initial jobless claims. So the real time, that is about as fresh of data as you can get access to on the labor front. But we also need to look at the value we can get from the monthly jobs report. This is the non-farm payrolls that I told you is only through March 14th. Now, what I like about this is you can see these numbers in perspective. You can see that before the Great Recession, December 2007 was the official start. It wasn't announced until December 2008. But after December 2007, it took 10 months of net job losses. Remember, that's jobs added and jobs lost, to get to minus 700,000. In today's landscape, the first month that job growth went negative, we went down 700,000. This is unreal. This just shows how quickly that change happened. And again, this number is only through March 14th. The next number we can get is likely going to be in the maybe double-digit millions as we see it come out for the next report. But looking at this, you can also get a sense of where is there the highest concentration of jobs lost. And the leisure and hospitality sector has lost 6 times as many jobs as the next section, which would be education and healthcare. When people see education and healthcare, they sometimes think that's a typo because we think of doctors and nurses and all of those people that are putting themselves at harm's way for us. But you also have to think about your dermatologist or your chiropractor or your dentist who has closed. And maybe they're doing emergency only appointments, but maybe they've had to furlough some of their staff, and that's going to pull down this number as well. On the leisure and hospitality front, though, what you see is this is really concentrated in some markets. Remember how we talked about 26 out of 1,000, 260 people out of 1,000 in Las Vegas have filed for unemployment claims? Well, it makes sense. That's their largest share of leisure and hospitality is in Las Vegas, Orlando, San Antonio, San Diego, Los Angeles. Now, as we look at these categories, we see that there are 4 that are at higher risk than others, and we expect these to just grow in the coming report. So whether it's trade, professional services, education, health, and leisure and hospitality. You can then apply some of that to different markets across the country to say, okay, which are the ones that are at the highest risk? We already see the ones that are listed here, but you also have to think about other parts of the West Coast that may have a high concentration of COVID cases that could put them at higher risk as well, at least in the short term. Now, when you look at the non-farm payrolls, what you can really gather from this, though, is that back in 2007, I told you December 2007 was the official start, and usually the organization that calls the start of a recession looks at the last month that job growth is positive. So given that, if you look at where we are today, I'm operating under the assumption that our official start to the recession started February 2020. Now, it very well could be March 2020 if they change their methodology for this, but the important part is you have within 2 months of when the recession starts. And if you believe that you can rely on any history or look at any kind of duration of other kind of cycles, this is going to be your starting point. Do you think it will be 8 months? Do you think it will be 16 months, 24 months until the economy has fully rebounded? This is your starting point. And by the way, we'll give you our forecast a little bit later. Now, that first section, I had warned you guys, is the ugly. That is the sobering part where you look at these numbers in absolute terms, you see them in a historical context, they are just alarming and they are painful. But then you have to think about government intervention. You have to think about the fact that the Federal Reserve is acting quick and they're acting hard. You have to think about Congress, who has passed trillions of dollars to be able to assist companies and to assist Americans to help weather this storm. And in fact, if you look at unemployment insurance right now, there is at least 9 months available at scattered dollar amounts. The most significant being up until July 31st, people that are unemployed will get their state benefits plus an additional $600 every single week. And why this matters. JP Morgan Chase has access to our data. They can look at how we've spent money, and they can look at people that have lost jobs and not lost jobs. Look at how they've spent their money. When they lost their job, what happened to spending? When they got unemployment insurance, what happened? And then once they got reemployed. What they found is that unemployment benefits avert 74% of the spending drops from a job loss. So yes, you are going to see consumer spending is going to pull back. There is no way that consumer confidence and loss of job does not impact the economy. But what JP Morgan Chase's research shows is if those people stay unemployed for only about 6 months, and then they can find another job, their spending can fully resume within 12 months. So there is going to be a hit. It's going to take about a year to see, assuming people it's a short-term unemployed situation, for people to get back up to where they are spending. But this is actually positive news. Don't look at it as negative, because that's a pretty quick turnaround from being really scarred and being nervous about your employment situation to going back spending as you did going into all of it. You also see the small business loans, the payroll protection plan, the PPP. And we went through the first $350 billion really quick. $310 billion was then assigned, and as you guys may have seen on Monday, they crashed the website because so many companies were trying to apply for this. If you're not familiar with the PPP funds, they're basically a loan to small businesses of 500 or fewer people, and they will be forgiven if the money is used towards payroll. 25% can go towards rent and utilities, but the companies cannot cut staff and they can't cut salary. And so these have been applied for like crazy. I'm sure you guys saw Shake Shack was one of the examples of a bigger company that maybe shouldn't have had access to it. A lot of confusion along the way, and that's because they had to enact this policy quickly. But what you can see here is that Nebraska, North Dakota, Kansas, South Dakota, Hawaii, those are the states that in terms of their eligible payroll got the most access to funds. Now look at the approved amount. These are not high. They're not taking a large share of the $350 billion, but they're also pretty small states in terms of their contribution to the wider economy. If you look at the bottom, probably the states that are the hardest hit, New Jersey, Washington, Nevada, New York, California, these are some of the larger economies in the nation, and they, because they're bigger, they have larger population, more companies, got on a relative base a small share of their eligible payroll. So it's going to be a really interesting thing to watch, because the plan of this is to keep the economy afloat. And it'll be interesting to see how the distribution through the next cycle goes. Do we start to see more of those California and New Yorks? I'm not saying they should get a larger share. You're just hoping that they're able to get enough to keep those economies afloat to then help keep the wider U.S. economy afloat as well. Now, through all of this, the biggest concern has been people aren't going to be able to pay their mortgages. People aren't going to be able to pay their rents. And we talked earlier about 7 million loans are in forbearance. I have a friend who owns a mortgage company who he said when all of this started to go down, they had penciled for 30 to 50% of people not being able to pay their mortgages. So he says, yes, that number 7 million is really, it's high and it's horrible for those people, but it's also way better than they expected. And so right now their company is still solvent. They're still able to move forward given how the numbers have panned out. Of course, there's still time for them to increase, especially as we have May 1st right around the corner. Same thing on the rental side. There was a lot of fear that people were either not going to pay the rent because they couldn't, or not pay the rent because they thought that they didn't have to. I know there was a little bit of confusion as it started to hit out that maybe people didn't have to pay their rent. I think once people researched that and realized that you would still have to pay and you would have to go on a payment plan, people that were able to either tap into savings or use some of the government assistance, they were largely able to make their rent. So actually for April, 89% of renters paid their rent, when the fear was this was going to go down to maybe 80 or even 70%. But note that this is not coming from 100. This is coming from 93% to 89, not 100 to 89. And again, like we said, this is really big thanks to government intervention. When you look at April, you have people that are maybe still employed. They have maybe some access to savings. Maybe they had their salary cut, but because of that savings, that's been able to help offset that, or they could work with their landlord and bank. So that gets you through April. Now you look at May. That stimulus check, that $1,200 for an individual started to hit the bank accounts about 2 weeks ago. Now they're still working through those phases, but hopefully that's there to help offset if someone has lost their job. That $1,200 can help offset the ability to make a payment. This applies to both the for sale and for rent market, by the way. Going to June, going to July, if you are not still employed and you do not have a savings account, this is where that JP Morgan research chase comes in, and that they see that the unemployment insurance can help soften the blow. So you do see that you have the state plus the $2,400 on the federal level that expires on July 31st. And July 31st is really the date that we are watching, that once we have this large share of the federal stimulus start to wipe away, then really what position are consumers in? What's been interesting as we've been doing our weekly webinars is that when I talk about the stimulus check, I've had some people comment and say, well, yeah, but it's $1,200. Is that even going to do anything? Well, you can look. You can see how $1,200 can assist renters and homeowners across the country. So if the market is a bright green, and Tim, I know you're colorblind, so sorry for the red and green here, but if it's a bright color, what you see is the share of renters who could cover most or all of their monthly expenses with $1,200 is pretty high in some parts of the country. Not high, obviously, in South Florida, parts of the Northeast, and then parts of the West Coast. Now, if you assume someone is married or coupled or has a roommate, now you have that $2,400 and you can see how that shift happens. So most parts of the country for 1 month, that $2,400 stimulus check can help cover most of the rent. On the for sale side, if you look at the percent that can cover most or all of the monthly mortgage and utilities, you can see a little bit more of that brown and red where probably $1,200 is not going to cover everything, but is obviously going to assist. If you get to that double, you see more of that green show up, but still parts even of Texas that's not going to be able to cover the entire mortgage and utility payment. So as we roll with this, we don't want to be too overly optimistic that, hey, everyone's able to make their bills and look, these numbers aren't that high, because we do know that's going to come at the expense of probably their debt load. And so when you look at overall consumer credit card balances, if you adjust for inflation and you adjust per person, we were not as high as we were going into the Great Recession with the levels today. But we do know that if that $1,200 isn't going to cover everything, you still not only have your rent, but you have your groceries and you may have school supplies and you have different things that you have to pay. We do think that credit card usage for essentials is likely to rise. And that's really important, and you'll probably hear Tim talk a little bit later about duration. That's been one of our biggest things that we've mentioned every webinar is if this goes on for too long and that debt starts to build up, that's when you start to say that the recovery is going to be a little bit harder than initially thought. So on my final section here, we just want to talk about how the housing market and the economy are working together or against each other. We track 18,000 actively selling communities across the country, and we can see which markets and what price points and what areas are selling the best. And we can also roll this up to get a good idea of what's going on in the broader housing market. Our new home pending sales index is based on contracts. And what we saw, and you can see this steep drop looks the same if you're looking at retail sales, if you're looking at GDP, if you're looking at really any indicator. When March hit and those shelter-in-place orders came, home sales slowed. Right now, we have the number is off 30% on a year-over-year basis. And going into April data, if you also look at the resale market, you see about a 31% drop year over year in terms of purchases for a home. But it also makes sense because how could overall volume not be down when you look at listing data on Zillow, people that are putting their homes on the market is off 50% compared to where it was last year. So we know that some people need to sell a home to buy a home. We know that the resale market is really connected to what's going on in the new home space. And when overall listing volume is down, it's really hard to actually see a high level of transactions. What I have found very interesting though, and it kind of jives with what Tim will talk about a little bit later, when all of this started to happen, I use Google search activity a lot to just get a gauge of what people are looking at. And one thing that I searched right as all this happened in the beginning of March, which was how many people are searching, quote, should I buy a house? It was at the highest level it had been going back to 2004. And that was the first point that that data was available. I said, that's interesting because the market's starting to look uncertain. People don't like uncertainty. They don't want to buy a home when the market doesn't look that solid. And yet people are searching for it. And so then we started to say, okay, are people looking to take advantage of the fact that rates are 3.5% and maybe even lower? And so we couldn't directly say what this was going on, but we said for sure, there's no way this is going to stay high. And we actually have seen going into this, the number has come down, but compared to the spring selling season last year, people are still searching for, should I buy a house at elevated levels? And you'll see as we talk about different sectors, housing really has been kind of the bright spot, not that it's doing fantastic. A lot of our builders have actually said their transaction volume is off between 20 and 50% as you move into April. But all things considered, I think people are quite happy with how the overall housing landscape has performed to date. Now, Tim will talk about some challenges moving forward. When we talk about the recovery, and these are my last couple of slides before I pass it back to Tim, when we talk about the recovery, I know a lot of people have talked about a V shape. Okay, we're just going to rebound really quickly, just start to reopen the economies and everything's back to normal. I don't believe that restarting an economy is as easy as flipping a switch. I think it's more complicated than people assume. There are a lot of questions about when will people feel safe. My mom has diabetes. She's not going anywhere until a vaccine is there. And that's going to impact consumer spending. That's going to impact the 55 plus housing market. Is COVID going to come back? Everyone's been saying, okay, the weather's good. We're seeing it's going to go away. This is going to be great. And then I was listening to the news today and all they talked about was, well, just wait a few months. It's going to be right back. It's not good for consumer confidence. Having not good consumer confidence or not economic confidence is not good for growth. There's also a question about just the global landscape. We are interconnected. What's going on with the global economies as they work together? How bad is the debt burden? How bruised are the supply chains? Lots of different questions that we're working through. So our forecast for GDP, and the way that you should look at this is us just basically telling you how we think the economy is going to perform in the coming months and quarters. So we think that first quarter, which will come out tomorrow, will be down about 3%. As we go into second quarter 2020, this is where we have basically all of April and parts of March or May that are going to be quite painful. We think that's going to be down 30%. We're the purple line, by the way. In third quarter, we have up 5%, and in fourth quarter, we have up 15%. But the reason I'm showing you both of those graphs is I want you to understand that when you see a third quarter that is positive, that does not mean we're back above the starting point. I know it looks like it here, but this is charting out percentages. When you come from a really low base of being down 30% and you're up 5%, you're still below where you started in that 4Q19 level. And up that 15% we're starting to see at the end of the year, we have these economies that have reopened, slowly starting to see, again, this is assuming that all of us starting to open the economy, this is going well, and we don't have to go back on shutdown. That has to be our operating assumption as we're doing these forecasts. And so finally, if you want to understand the shape of the recovery, that's what a lot of people ask us. As I mentioned, I think a V is too sharp. I think a U doesn't actually make sense because you're too long at the bottom. I do think if you look at Georgia, even having some of those companies start to open, that is going to contribute to growth, assuming that they have some consumer demand. And I think the pickup is too abrupt. So basically, you've seen my quantitative numbers. I also decided to just draw it. Let's just see how it looks. And so if you draw the shape of the recovery, you can see that we still don't have it fully back to where we started 16 to 20 months from now. This is looking at the economy. But we do think that you'll just see fits and starts. You'll see growth. You'll see some pauses. You'll see some growth. But it's going to be on this positive upward trend, which really, after I drew it, realized what I drew as a bumpy Nike swoosh. So that's how we forecast the economy to recover. We do have housing starts that we think will be off at least 20% this year, but that's completely dependent on market. And that's what Tim Sullivan will be able to tell you guys about today. So let me bring back in Tim Sullivan, our senior managing principal. As he mentioned, he oversees our entire custom market study business and helps our clients try to make sense of today's landscape. I'll say what I love about working with Tim is not only is he available at 7 a.m. and 11 p.m., it doesn't matter, he's always going to be working, he's always curious, trying to make sense of things, but Tim also connects the dots. What he does is every day he's on calls, he's on virtual meetings, talking to division presidents, talking to owners of companies, land brokers, talking to analysts across the country, and he takes what he learns, and he's able to, for a lot of people, they just hear a lot, and it doesn't really make sense to it. But he takes that, he combines it with stats, he weaves the whole story together, and he can actually tell you what is going on the ground. So Tim, let me turn it back to you.
Allie, I appreciate that. Thank you for that lovely introduction. And before you go, what I want you to think about is a response to the question I'm about to ask, but I want to preface it by sharing a couple things with the attendees first. The question really is, when you're looking at all this data, the one thing that is the biggest surprise, positive or negative. But before answering that, I want to make sure that the audience knows that Allie wasn't kidding when we are spending every day and many of the evenings trying to decode what's going on out there. And we're doing this through our regional director network. We've got 15 regional directors nationwide that are embedded in markets, and our 40 consultants who are out there interacting with capital sources and home builders. And you'll see with the second half of this presentation, there's some hardcore data, there's some interpretation, and there's some guesswork. But all those things considered, we see some direction. Now with that, Allie, go back to the question, the biggest surprise that you've seen in the research, whether it's positive or negative. Share that with us, please.
Biggest surprise to me, and you had mentioned we are on these calls, we were on a call right before we jumped on this, the regional differences. And I guess it makes sense because each of them have different components that drive or pull back strengths. But you can hear one market say, this segment, it goes down to not only regional, then you go to the market, and then within the market, it's down to, and Tim had said this to me, almost down to the street level, almost down to the house. And I think we've always known there's no national housing market, but usually in a stable time, you could look at Charlotte's top level trends and have a good idea of what's going on in Charlotte. Today, you're really like, okay, Mecklenburg County, but where and what part, north or south, and on this street, and what's the house, and what's the price, and who's the buyer? And I've never seen it be that specific.
Right on, Ellie. And we didn't talk about that question beforehand. I just popped that in there, but I couldn't agree with you more. So we'll move on. The first thing that I want to share with all the attendees is just some of the elements we're hearing on the street, specifically related to attitudes. The first is that we've seen in the last couple of weeks, the initial shock has moved through and there's a level of acceptance. And if you're familiar with the various levels of grief, we're now in that acceptance area. But as Ali said, that second bullet point is probably the thing that I would agree with that is the biggest surprise, is that there is inconsistencies. And it doesn't matter if we're talking a difference between Texas and California. There are inconsistencies in a great market like Austin, which I'll tell you about in a second. The commercial real estate space, which this presentation is not about, but I want to touch upon, is really in a strange place because many of the capital sources we work with are also in the space that is considered commercial. You know, office, they're getting hit pretty hard. And in fact, we at Meyers Research Metrostudy, we have 38 offices nationwide, and we are negotiating with our landlords about space that we no longer need, or quite frankly, additional space or less space. I think what we'll see with the office space is that it's still going to be in demand. The collaborative element, the convening element is still there, but the intensity of use will go down, meaning we won't pack as many people in per square foot as we have been. But I think longer term office can hang in there, and the most important thing to pull from the office side of the world is, like the residential side, it's not overbuilt. When we jump to retail, a little bit different because, you know, the retail side has been hit so hard because we can't go into most stores unless it's a grocery store. But the experiential part of real estate, particularly thinking about indoor-outdoor spaces, I think we're going to find there's still massive opportunities there. And ground floor retail in residential may be able to hold up because of the local serving needs. As we look at industrial, it's the darling of the space right now, but you have to bifurcate industrial because there are the big users like Amazon who are doing very well, and there are the smaller users who are struggling like many of the retail side. And last but not least is hospitality. We're going to see a massive shakeup in hospitality, and mark my words, the hotels are going to have fewer services and fewer restaurants. That's just two of the ways they're going to have to ultimately relate to this shift. Back on the home building side, cancellations are definitely related to financing. And here's one of those surprises. Foot traffic is showing up in some markets. Now, there are huge geographic differences, and these geographic differences have to do with, well, let's start with really around the country, kind of markets and how well they're doing. Ali and I like to try to separate which markets are doing better versus others. Which markets are awesome? You know, kind of like the first quarter of 2020? Well, none of them are. But all things considered, some of the markets that are doing pretty well, most of the markets in Texas, the public builders that are in the Mid-Atlantic, and then the Carolinas, they're looking pretty darn good. Atlanta's a surprise. It's been working pretty well. Home builder layoffs, I'll talk about that in a second. So far, they've held off. But on the meh side of the world, we have California and Colorado. Colorado was an absolute bullet. It was a comet. It was doing absolutely beautifully. Denver was one of the hottest housing markets in the country. But it's been hit on a couple levels, including from the energy side, so it's slowed. And California has been hit because it's such a jumbo market. The jumbo mortgages are so important here. You heard Ali talk a little bit about, leisure and hospitality. Of course, Orlando, Vegas are there. And I'm disappointed to see that the active adult market has really been hammered because there's so many terrific communities, but we have to remember that buyer is so discretionary. But how is traffic moving? And when we look at the way people are ultimately thinking about the market, we still have people shopping. The concerns we have to do with underwriting and builder liquidity. And will resales flood the market? If you heard what Ali said, listings were off 50%. What would happen if we suddenly had 50% increase? Personally, I think it would not hurt the market. But these last two factors are of big concern to us. Number one is supply chain disruption. And we're hearing imperfect elements there, whether it's coming from China or it's cabinet makers in Pennsylvania. But one thing that we're positive of is municipalities will be increasing taxes in one way, shape, or form, whether it's impact fees or permit fees. Now, I was mentioning traffic, and it's fascinating to see how quickly our builders have pivoted. And if you look at the blue line, this gives online consumer traffic, and our friends at BDX have supplied this. And look what we have on the far right side of this graphic. We have an inversion, meaning we had year over year more people in the middle of April looking for homes online than we did last year. And look at that trajectory since the middle of March. It's pretty significant. The good news about this is that not only have the builders responded well, but we have seen that the buyers, the consumers, are responding to online traffic. We've had a couple builders tell us that they have pushed their trajectory of technology in 2 months in a direction that would have taken them 2 years without COVID. So there's one of the relatively positive elements. Now, contract sales. This goes back to this inconsistency element. On the left-hand side, you can see the responses. And by the way, our response here is about 350 division presidents from across the nation. So we're representing the vast majority of the new home market. But the left-hand side is that we've seen increases. And, the numbers that you see there, it's almost 50%. And last week it was 21%. So we've seen the contract sales go up. And on the right-hand side where you see decreases, it's now 20%, but it was 44% last week. So we saw a pretty fast shift, and to us that reflects a confident buyer. But on the left-hand side of the screen and the right-hand side of the screen are comments that we've heard that fly in the face of each other. Look left. This week felt better. Look right. Net sales are tough. Look left. First time in a month we've had a normal week. Look right. Very poor levels. So you can see that there is this inconsistency that Ali talked about that we're seeing on the ground everywhere. And the concept of pricing is also an important factor. When you look at the percentage of builders that kept their base prices flat, in this last week it's 93%. Last week it was 97%. So we're starting to see a little erosion there. The middle number, 39% of builders increased incentives. Well, that's tracking consistently with what I just said about prices, because a week ago it was only 30%. So we're seeing incentives go up and prices getting jockeyed a little bit. And then the cancellation rate, that actually has gone down simply because we have seen some of the contracts and conversions happen. Last week it was 31%, this week 28%. So that goes back with this ping pong element that is existing in the market. I mentioned staffing, and so far we're happy and confident with the way builders have responded. The right-hand side of the graphic gives you a 71% response rate where the builders have said they've left staffing unchanged. Let's watch what happens in May, because, Ali, we might find that this number changes significantly if many of our markets do not reopen and we can't rebuild the backlog of homes. But right now, it's relatively positive. Again, I'd put that on the debit side or the credit side of the setup. All right. So development plans, what the heck is going on? And this has everything to do with many of the people on this call. What's happening in land and how do costs associate with that? And what does capital feel about it? Well, as you read across, we've got about 6 or 7 factors we want to evaluate for you, and we're comparing 2 different product types. Single-story apartments, which are really those pull-apart apartments. They are mapped as one unit, so they're not single-family. And on the right-hand side, it's single-family builders. That could be rental or for sale. But when we look at the demand for land, for single-story apartments, it's still pretty strong. And I think we're working on something like 7 different analyses right now in 4 different markets on that asset class. But for the single-family builders, their attitude on land is, whoa, 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 look but don't touch. Now, what about land prices? With land prices, the single-story apartments right now, the value is still pretty steady. On the single-family builder side, pay attention to this one because something's got to give. In my next graphic, I'll share with you what that is. Let's talk a little bit about the capital side, equity and debt. For the single-story apartments, it's on hold, but there are a couple. In fact, I had a phone call last night with a builder who does have a capital source who will look at that. So maybe that's on hold, sort of. But the single-family builders definitely on hold. The capital for construction and land acquisition is being held. Now, what about construction costs when we start to go vertical? Well, for the single-story apartments, so far it's pretty steady, and lumber's gone down, which helps. Same with single-family builders. But as we move to the 4th quarter, we might see that construction costs go down for both. And we attribute that a great deal to the fact we've slowed down in construction, and we're in a position where we think labor will probably play ball with us a little bit more. And then prices. They've been stable per door for the single-story apartments. Single-family builders, we anticipate they may drop a little bit towards the end of the year simply if we have this duration go out a little bit longer and we're not replacing homes. It might be what has to happen to push us back to the market. But let's talk more about land. And there's multiple players who have different drivers. And for builders, I just mentioned to you, they're on hold. They want clarity. For landowners, they're sticky. You know what? We'll sell, but you better be ready for our price. And on the capital side, they're waiting for that repricing element. So which one moves first? That's really the question. And I think what has to happen is that there's got to be some level of discount, whether it's a discount in a home price that trickles down to land, or for land, it's a direct reduction in cost or reduction in price. But this is the push me, pull you that's happening in the market right now. And we anticipate sooner or later one of those will thaw and then the freeze is over. Let's talk briefly about what's happened with land and lots too. And we dug a little bit deeper into the element of land and lot acquisition. And if you look left, it's last week. Right, it's this week. And notice for the right side, the selectively moving forward, which is the bar in the middle, is actually increased. And I attribute that to some of the markets where we have movement, specifically the Carolinas and Texas. But when you look at it on a blanket basis, there's still a great deal of concern. We're often asked about the one thing, and Allie, I ask you this question all the time about the things you're looking at, and we've boiled it down. If there's a takeaway for you today on a metric side, pay attention to unemployment rate. Because the correlation to housing starts and unemployment rate is negative, so they move in opposite ways, but it's highly correlated. So to remind you of your stats classes back in high school and college, the R squared is really how those two fit and the level of correlation. Perfect correlation is 1 or -1, perfect opposite correlation. And you can see that over the last 30 years, the relationship between unemployment rate and starts has become unbelievably powerful. So for all of us in our local market, nationwide, track that number. Furthermore, how do builders think that this year is going to go? And Allie, what's fascinating to me is you look at this middle line where almost 60% of the builders think they're going to hit 80% of their plans. This is for starts. But if you look left and include, 100%, the 20% of the respondents think that they're going to hit 100%, holy cow, there's still a pretty solid expectation in the market that we're going to be within 80%. Now, notice what Allie had been talking about regarding our projections. They do vary somewhere between a 20 and 30% drop, both for starts or for closings. But keep your eyes on this because it could vary strongly if those markets that are out early really get to a place that they hit numbers at or better than they expect. And there's another outcome here regarding maybe an unintended benefit with regards to what's happened to technology and working with online. And that has to do with working with inspections and permitting and municipalities. Now, things have been slowed down, period, paragraph. There's no two ways about it. And some cities still aren't operating. But there are multiple cases where builders have reported to us that they've been so pleasantly surprised with the efficiencies that they're getting from certain cities, and the fact that they can get 5 people on a Zoom call, where it used to take them 5 different meetings to get these people together to get approvals. And because the Zoom is recorded, people are a little bit more mindful of their responses because they'll be held accountable. So this is an outcome we're going to keep a very close watch on. Next thought process, inventory. And the next couple things are inventory before we wrap up. And what I want you to take away from this is that not only are we not oversupplied, in many ways I can argue that we are undersupplied when it comes to lots and finished vacant inventory. Finished vacant inventory, homes that are built and unsold, look back to 2009, and we're at almost half of where we were at that point on an absolute basis and also on a month supply basis. 2 months of supply is really probably too low. That implies there's upward pressure on pricing. So the key thing from here is that we see finished inventory really in a pretty good place. But let's put it in context. As you read left to right, the gray is the Great Recession max number for finished vacant units, months of supply. The orange is 2018, and 2019 is blue. And Ali, I hope I got those numbers right, because you know I fumble with the color once in a while. But the big takeaway here is perspective. When you look at this, what we see is the simple fact of where we are now at the end of end of 19, and where we were at the Great Recession max, still very significant difference. And let's go even a step deeper. Our Zonda database allows us to look at quick move-ins almost on a daily basis. And quick move-ins are truly homes built, unsold, and out there ready to be sold. On the left-hand side, it's the U.S. You can see we've seen a spike from below 24,000 to 25,000 and change. It's slightly less than 2,000 units. And then for Charlotte, we've seen a similar upward movement from 100 to about 140. Both of those numbers reflect about a day's supply in their respective markets. So a day's supply in the U.S. or a day's supply in Charlotte. And most of the markets we're tracking are that way. We do not have an issue with standing inventory. However, there's a double-edged sword, and let's talk a little bit about spec inventory. The spec inventory bad news is builders are pulling back or being concerned about this because they've got to preserve liquidity. That's good news, bad news. They're being careful. But standing inventory, spec inventory, is the majority of the product that's selling and selling quickly. People are relocating. People have decided to move. Damn the torpedoes. We know COVID is here, but interest rates will never be lower. And the thing that we are hearing from builders is that they're struggling with this. And go back to the element that I mentioned, that we don't have an oversupply, and we've got spec inventory as being the product that sells well. That really becomes, the challenge in the market. I think I can make a heck of a case for additional spec inventory going forward. All right, let's put a couple final thoughts together before I bring Ali back. That lower right-hand picture is John Krasinski, and John does a webinar himself that is a really sweet take on the world, and it's SGN, some good news, and he's inspired us to try to share the same thing every week. You heard what Ali said, you heard what I said about inconsistency. Look at the first bullet point. This is Northwest Austin about a week ago, where pending sales are down and listings are down. There was a home that sold at $775,000. I beg your pardon. It was listed at $775,000. There were 10 offers on it in the midst of COVID at a high price in an arguably pretty strong market. To us, that means special product, special location is the driver. Whether it's land, a perfectly located parcel of land, or it's a beautifully structured concept house, great product still works. We are keeping our eyes on Apple, because Apple as a company played this well. They've got a huge amount of capital, a huge amount of cash ready for this downturn, but they continue to innovate. And we're trying to push our industry that way. We are doing that. As you just saw with Bird Eye, we're bringing in satellite technology. We're trying to push ourselves all the time. And Jeff Meyers, our CEO, is constantly challenging us to disrupt ourselves. I love the take about the Colonial Steakhouse, and somebody took their stimulus check and gave that $1,200 as a tip for a to-go order. The kindness there is incredible. And in one way, shape, or form, this large gathering is good when you see all of the efforts that are going forward with drugs and vaccines and non-drug therapies. I appreciate that. I think everybody on the call appreciates it. And with the know-how and the stick-to-itiveness that the American mind has, that really bodes well for us going forward. And the last couple things here. These are all 100-year-old people or greater that came down with COVID and survived. And in reading about all of these people, the doctors actually suspected that when they were infants, they had been exposed to the Spanish flu. So they are double survivors, and just, love the feel-good story about these elderly people making it and moving on. Okay, going forward, we've got to chart a course. And you heard Allie talk about Mayor Goodman II on the left. She says we've got to get Vegas back to work. And Dr. Fauci on the right saying, whoa, 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 we have to stay healthy. Well, the answer lies somewhere in between, because we have to do both. We have to somehow figure out a way to get back to work, and we have to maintain a healthy environment for our families, for ourselves, for our industry. And the question that we pose is, how might we do that? And I will tell you that Allie and I are finding out from our interviews with builders that they are trying to adhere to CDC guidelines. They're trying to do the right thing legally, emotionally, medically. And there's fits and starts, but the course direction is right. And that's the question, and that's the challenge that we pose to everyone on this call today. For your families, for your industry, for your companies, how might we chart the course back so that it's safe, but we also can rebuild the economy? I, for one, absolutely believe in that hockey stick that we saw put forward in the beautiful artwork that Allie did. But we'll see as time goes on, because really our take is this. Allie gave us an inflection point, and that's so important. The recession started in February of 2020. That inflection point allows us to set expectations for, is it a short, medium, or long-term recovery? Government intervention. You heard how Allie laid that out. It's a bridge. It's not the answer. It's not the panacea, but it's softening the blow. The stimulus will be there too. And Allie, thank you for always showing, even though I can't tell green and red, I can see darker and lighter. Thank you for showing that will have an impact. And the duration. I mean, I think that's one of the biggest takeaways for all of us, and the thing we have to mine very closely is duration will drive spending, which will drive this recovery. And ultimately, it won't be seamless, but charting a course for how we might bring it back is how we all can come together as an industry and figure out the way back to a healthier economy. With that, Matt, let's come back to you. I think we have a couple minutes for questions. Allie and I are both on the line. Let's go.
Perfect. Let's see. First question. Someone was asking, Kent Simpson asked if the use of RV parks in the 55 plus, active adult sector will increase this winter due to folks being tired of being cooped up but not ready to buy a retirement home. Any thoughts on that?
In fact, not only do I have a thought on that, I completely believe in it. And my brother runs a small casino in Reno, which is shut down right now. The only thing still working is their RV park. It's the mobile safety factor. So it's a terrific question. I think it's an emphatic yes, because those people who own the RVs can be mobile, they can get the heck out of the house, but they can also self-quarantine in many ways. So terrific question. And Allie, let's include that in one of our bright spots going forward, because I think it addresses many of the concerns related to COVID while still allowing people to be mobile. Good question. Perfect.
Question from Larry Ilfeld asking about getting a copy of the presentation, and does he sign up for the weekly call or weekly webinar you guys are doing? I'll take the first part. Larry, this webinar is going to be recorded. It is recorded, and for the, anyone that wants to share it, hear it again, or just play it at the next party when we can all get together again. It'll be available on Realtors Land Institute in the next couple of days. And then, Tim, could you address where they could sign up for the weekly webinar?
Yeah,
you bet.
So it's on.
Go, Ellen. You go. You know better.
It's on MyersResearchLLC.com under our events tab. you'll be able to find the registration. It's free. It's just a little annoying to put in a few details, but you'll be able to get through it quick.
Perfect. And I can vouch for you guys do quarterly frame events in a number of markets. I mean, all of their events are top notch, and what you're seeing today is representative of the kind of product they put out there and knowledge that they bring to the table. Next question, where do you see pent up demand? Any market, any product type, any specific bright lights out there?
Allie, do you want to go first? I'll follow up.
Yeah, and so when we look at pent-up demand, so a few ways to address it. I focused a lot of my career on understanding millennials, and for the past 4 years, we have conducted a millennial survey. And going into COVID-19, we did the survey on January. So before you discount it, what it did tell us is that 35% of millennials, 25 to 34, were planning on owning a home in the next 1 to 3 years, buying a house. And so as we look at that, we do know that some of them are going to be a little bit scarred by them living through the first recession. Some of them may have had their income cut. Some may be a little bit anxious. But I think going forward, there's no denying that there is a huge push on that demand side of millennials that still want to own homes. And an interesting tidbit from our call this morning with our regional directors, some of the gentlemen that are doing active adult, but down in the kind of southeast Florida area, said that maybe some of the active adult home sales were lost for this season because they've seen some of the snowbirds start to go back up to the Midwest and Northeast, but it's not a loss of demand and a loss of interest. It's just that that's going to get pushed back a little bit.
And I'd throw in a couple of things, Matt, real quick. I think the single family rental side, homes that are rented and single family continue to be strong because of the capability of no down payment, flexibility, and you're in an enclosed home. I also think we've got pent-up demand for the build-to-rent, that is that detached apartment where we get 10 or 11 or 12 units per acre. Furthermore, anything attainably priced in any market is underdeveloped, and we are looking at the manufactured housing side of the world as adding some additional elements to that. And I think ultimately that, price is still going to be a massively important element in any of our markets.
Awesome. Thank you. A couple more here and then we'll wrap up, respectful of everybody's time. Any action from local governments cutting impact fees or other actions to stimulate construction?
Well, think about that from both standpoints. The impact fees, I think, are trying to offset the loss in activity and taxes. And we can name a couple of cities. In fact, tomorrow on our webinar, we're going to talk about one of the Florida cities that's putting an impact fee in that's equivalent to $13,000 on an average price of $240,000. It's a almost 6% increase in home price. I think we're going to see that in many markets. It's going to be in the guise of impact fees, permit fees, just even sales tax. So prepare yourself, because it's going to be one of the ways the cities are going to look at to try to repay what has happened, either the lack of tax revenue or some of the functions they've had to put out to help the government policies. So I think it's here to stay.
Yep, and starting at the state level and not focusing just on housing, when you look at the 26 million people that have filed for unemployment claims, yes, there's the assistance on the federal side, but those numbers were unprecedented. None of the states had budgeted for that they couldn't have, even in their worst case scenario, imagined as many claims as they're getting today. So they're already talking. I know at least where I live in Los Angeles, the mayor came out and said that they're going to cut services, they're going to cut jobs, they're going to maybe have to cut some pay. At the same time, there may be talks if you have a big pension that you have to pay out, maybe you have to raise taxes. So there will be implications on this on a wider statewide front as well.
Perfect. And then final question, any impacts you see lasting from a virtual education standpoint that might help school crowding or inability of schools to keep up with new demand from housing or anything like that? Any thoughts there?
So
outside the scope
we have a consumer specialist, Molly Carmichael, who has been kind of focusing on maybe this shift is going to be permanent and how do you design a home to allow for that. I know, at least from my friends that have young kids, and at least if they're working, they have found that it's been quite difficult to do their work while also kind of managing some kind of remote learning. So I don't know if it's going to be a massive shift. I think we could probably see in some areas this could benefit. But Tim, do you have any insight there?
The school thing is going to be an interesting one. New construction is dependent on schools. Certainly, we have to have them together, lockstep. I think we're going to see schools respond in a similar way that offices do, whether we do staggered times or we have more space for the same number of kids. I think that's ultimately a big thing will change. But beyond that, boy, it's still going to play out. I hope that answered your question, Matt.
That's great. Guys, I really appreciate it. I think my takeaways from today are, substantial regional differences. Really, we should watch unemployment, and it'll be interesting to see how the correlation plays out, with the kind of unemployment we've had this go around, and what we really need is supply. We had a limited supply coming into it, and as Allie, you hit, us millennials are becoming adults and might actually want to buy a home someday.
Matt, I think you've been an adult for a while.
I'm the first year of a millennial, apparently, so go figure.
Right on.
So, guys, Tim, Allie, amazing. Appreciate the insight. Thank you so much. Again, everyone, we recommend you looking in Meyers Research, Meyers Research LLC. Look at what they do. This is great stuff. This is what they do every day, and it's really helpful. I share it with clients all the time. And on behalf of RLI Future Leaders Committee, Tim, Allie, again, thank you so much, and thank you all for attending the COVID-19 Impacts on the Residential Land Market webinar.
Thanks, Matt. Thanks, Amanda. We appreciate it. Take care.
Thank you.
Thank you.
Thank you. Bye-bye.